Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, a U.S. economist at Nasdaq, and Ken Ryan, Portfolio Manager at Parnassus Investments. We're here to discuss the role of international markets in today's environment of policy shifts. It is great to have all of you with us. Welcome to Trade Talks. And really, the big headlines have been around tariffs, essentially since, the beginning of the year. What implications do you see this as it relates to the global markets?
Yeah, thanks, Jill, and thanks for having me here. It's great to be on the show. So I think, of course, tariffs have been the narrative all year long, almost persisting headlines every day. For us, this is a good reason and a good reminder of why diversification is important for U.S. investors particularly. We've had a really solid, not only 2-3 years here, but almost a decade of just U.S. outperforming very strongly, and many have forgotten why exactly diversification may be important. And tariffs is a good reminder here, because as we know, tariffs are a very U.S.-centric phenomena, and international investing, while I do have companies that are exposed to tariffs in the portfolio, there are many that aren't at all. No U.S. revenue, no U.S. exposure whatsoever. And when we look at the landscape, you have an international asset class that's cheap relative to its history, much cheaper than the S&P 500, and what we think is a really good opportunity and a really good shift or a break from the tariff narrative we're hearing really every day here in the U.S.
Yeah, and in fairness, the international trade was outperforming the U.S. market even prior to tariffs really coming into the picture. To your point, the valuation was attractive.
Yeah, and it's not only the valuation. We're looking at Europe, and it's such a different dynamic here in the U.S. You really haven't had the big post-COVID recovery or the big economic boom. You're just starting to see that. You're starting to see rates come down. You're seeing real fiscal spending in a way that we haven't really seen in quite some time. We're talking €1 trillion potentially over the next 10 years. It's just a very different dynamic from the real uncertainty and that you're seeing here in the U.S.
Yeah. So, Michael, welcome back to the show as a dad. Congratulations. Speaking of Fed and its policy and how we're performing relative to Europe, of course, trying to figure out what the expectations are in terms of when we will see, if, an interest rate cut. And it's becoming a topic of conversation, making the headlines not just in finance.
Yeah, it's gotten a little bit more complicated after the CPI report yesterday, where we're starting to see some hints that those tariffs are actually making their way into goods prices. If you're looking at goods inflation relative to how much we rely on imports to meet consumer demand, the things that we import most are seeing the most inflation. So things like toys, things like furnishings, appliances, recreational sporting equipment. So those types of things, it's kind of starting to show up, and this is something that we've been waiting to see for a while now, but it makes sense that it's only starting to flow through recently because, of course, we had those record trade deficits at the beginning of the year when everyone was rushing to get their imports done before tariffs kicked in. And then, of course, the delays and the negotiated lower rates for tariffs made it a little bit easier to hold off on raising prices. So we are finally starting to see that now, and the net result that we've seen is that September for a Fed rate cut is looking a little bit dicier than it had been just a few days earlier.
Yeah, I mean, it's going to have to come out of somewhere. Affordability is going to impact the consumer at some point, and that's what we're trying to figure out where. And Chris, maybe we'll learn more during the earnings season that's kicked off in earnest. Because for the most part, the market has digested the headlines well.
We've talked about this before. The market's still resilient, right? And if you look at the data, that is always backward looking. We've talked about this well before you went on paternity leave, while you're on paternity leave, and still we're talking about it today. Consumers still relatively strong, jobs are still relatively plentiful, layoffs are still relatively in line, wage growth is still okay. The consumer spend is there, which is kind of what the backbone of this economy really is. The TINA trade is really diversified significantly, right? You've got a lot of spend going on in Europe right now, especially in infrastructure and defense. Up with the obvious that's going on there. Germany is a perfect example of that. So there's definitely opportunity where Europe has been beaten up, ignored for many, many years. And you'll get a flare up here and there where all of a sudden people get excited, but now there's something significant about it that's going to be good. For the US stocks, everyone's been chasing tech and AI. Now you're chasing tokenization, crypto, digital as well. So there's going to be a lot of people playing catch up there. A lot of sectors are still getting hurt significantly across the board. Select staples, we talked about this before, you know, snacks, companies like that, big major companies just can't get any traction. And that goes back to the same questions on tariffs. What are the input costs going to be? What is that effect going to be? What's consumer spend going to be for that, right? You know, majority of consumer spend right now is still the upper bracket. That's the majority where the money's being spent. That's buoying everybody up. The bottom third just doesn't, they're doing without. So it's a problem.
Ken, which regions or sectors outside of the U.S. do you believe are currently underappreciated or just overlooked by investors?
You know, I think we're hitting on one of the key trends here in Europe, but I think it's important to one, go a couple levels deeper and see like the stocks or sectors. So you see this infrastructure spending and you're thinking like, how can we really play that or get exposure to that? So Siemens Energy is one we own that's, you know, really a electric grid infrastructure play. So when you look at not only a grid in Europe that's 40 to 50 years old, but also all the incremental spending you're seeing in AI and data centers, that's driving a huge need. And this is a 3-player market globally. It's a very capital intensive industry, very hard to get into. And it's one of these, like, we focus on moats and competitive advantages a lot, and it's one that's really there. And on the other side, I would also say overlooked areas with all the chatter and noise in the US on tariffs and supply chains and the impacts it's gonna have, we should remember there are also opportunities here. So DSV is another one we own. They're a global freight forwarder. And when you see environments like this, when all of a sudden companies are having to completely redo how they're moving things around the world, and when the narrative on what's gonna cost what with tariffs is changing daily, a company like DSV thrives on that. So I think not only are there sectors and regions being overlooked, but also on the company level, there's plenty of ways to get exposure to attractive opportunities no matter the environment we're in.
So even with a company like DSV, once, let's say, tariffs, there is an end goal or you know, we get this finalized, global trade partnerships and patterns could change, which is, I would imagine, a longer term story for DSV.
Yeah.
Because it's not static, it's a dynamic environment.
Yeah, absolutely. And I think if you look at, you know, the huge supply chain crunch we had a few years ago is a great example. You know, all of a sudden, if I'm a company, I'm having to, you know, really think on the fly and move on the fly. And a company like DSV is exactly the partner you want to be able to do that. And I think on top of that, this company has a multi-decade history of just doing larger acquisitions and deals to gather scale and then injecting really good IT to make it better. So you have like a tech forward company, global scale, great partner to so many companies around the world. And it's like, for tariffs, you're like, this is the partner you want.
Yeah, which makes sense because, I mean, that's a capital intensive business. So to grow via acquisition instead of organically, have to do it and then just plug and play your tech expertise.
I would say usually large scale M&A pretty hard to bet on.
Right.
With DSV, multi-decade track record of doing it and doing it well. Like those are, you know, as bottoms up stock pickers, like those are the ones you look for with deep diligence. You really discover something unique.
So your strategy is fundamental and active in nature.
Absolutely.
Yeah, especially for, you know, it's interesting. We were talking about the U.S. consumer before, Michael, and Chris and I have sat on a couple panels where we've had data providers on the finance and consumer end, and their balance sheets are actually pretty decent. We hear a lot in the headlines about fiscal spend and sustainability, but you know, for the most part, U.S. consumer balance sheets are not as bad as you would expect.
Yeah, I mean, we've got home prices around record highs. We've got stock markets around record highs. So if you own assets in the U.S., you're doing pretty well. Like Chris was saying, if you're in the bottom third, maybe you don't own your home, maybe you don't own stocks, then you're struggling. So it is a bit of a haves and have-nots sort of situation still, but for people that own assets, they're in a pretty strong position here, and that gives them money to keep spending and, you know, faith that they can afford it.
Right. Well, I mean, even with the labor market, there's this narrative, oh, AI is going to take jobs, or the tariffs are going to, you know, the companies are going to have to cut back. But there hasn't been much movement there either. Again, we haven't really gotten into the second half of the year yet.
Yeah, we're still adding about 150,000 jobs a month the last few months at least, and that's, you know, pretty solid job gains. I think maybe people got used to kind of the post-COVID job numbers, where it was we'll add 400,000 jobs a month, which is not normal. If you go back to pre-COVID, 150,000 is a good amount of jobs to add. So it is, and Chris was saying this too, right? We have steady hiring and we have low layoffs. So the labor market and the economy in general, it's just kind of chugging along. It's nothing flashy, but it's doing all right.
Well, we'll take that for now.
Yeah.
We have to deal with the headlines. Well, Chris, on the Markets Intelligence Desk, you cover consumer, or a good chunk of it. So you're talking to our NASDAQ-listed companies. What are you hearing on a high level from corporate management in terms of how they're perceiving the environment?
Uncertainty, even though it's not as uncertain as it was. It consistently happens. I had a conversation yesterday, another one today, two different companies, both on the consumer side, one in the restaurant space and one in the snacks business. And
those are two tough ones.
Two tough ones. The restaurant space, that company is trading near all-time highs, believe it or not. It also has a very high short interest. And they're concerned about a number of different items there. And then on the other side, it's a generational company, and they're trading at multi-year lows. They're trading at pre-COVID lows. So when you look at the dynamic of what's going on, their questions are very different, but the basis of the questions are the same. It's the uncertainty around the spend, uncertainty around the consumer, it's uncertainty around the supply chain, and how are they going to be able to take price on margin or not.
And consumer companies typically have smaller margins than tech companies.
They do, and that's the problem. So if you look at the PPI number today, it's trending a little bit better, a little bit cooler, which is good, right where the Fed wants to be. Seems that that's okay. The CPI number was, not bad, not great, not bad. So I don't know where it's going to get. The point of the conversation, though, is that investors are not chasing these companies. The restaurant company is doing well, the volumes are okay, and it's trading higher, but the short interest continues to tick up, telling you that people aren't buying into it. The consumer staples company is trading at all-time lows. Investors aren't punting, but nobody's adding. So where are they doing? It's going to tech, it's going to AI, it's going to utilities for the infrastructure spend there. That's where they're putting their money to work if they have ability for free cash flow. Everything else is just channel trends right now. And that's part of the problem. It's not every sector that's doing well here.
Yeah.
Right. It's not every sector. It's the weightings of the big boys in the sectors that are making new highs in the NDX, making new highs in the S&P, making the Dow hold up very well. The Russell's not doing so great. It's okay, but not doing so great from the April lows. It's flat for the year. The mid cap is doing okay, right? The S&P 600 is doing okay, but not great, right? It's all the large cap weighted names based around tech and the peripherals of tech that support that infrastructure for them. The other sectors are still hurting a bit.
So Ken, let's wrap up here and learn about an international fund that was recently launched, PRBRX. There's some names in here that I'm familiar with.
Yeah.
Tell us about that.
Yeah, absolutely. Well, it's interesting building off your point. I think when I look at the last 5 years, you have had COVID, you've had a big post-recovery boom, you've had inflation, you've had a global supply chain crunch that caused a lot of that inflation, and now you have tariffs dominating headlines. And you look at that 5-year period and ask yourself, what types of companies have really done well over that period? And I think I could easily separate into two categories. There's a type of companies who it always seems like something macro, something headline related is going on and hurting their business and they can't get through it. And then you have the ones that somehow, for some reason, they just keep doing well. And again, in a concentrated portfolio like the one we're running here at Parnassus with the International Fund and our other concentrated funds, we focus on finding those really good ones. An example I'll give, there's a company, 3i Group, and their main asset is this retailer called Action. Most people in the US probably haven't heard of Action. I'm sure everyone has heard of Costco, Walmart, Home Depot. You look at Action, their sales and their growth has compounded at a higher rate than all three of those US retailers over the first 20 years of its history. And why? They have a very unique concept, very low prices, quality products, and this concept's resonating in 12 countries now throughout Europe. So it's interesting, a lot of companies I talk to, they are talking about tariffs, how it'll impact their business, how weak Europe's been, how the consumer may recover. And you talk to Action and they're like, well, we've grown store count 10% a year for the past 5 years. Our same store sales growth has trended almost double digits over that time period. This isn't a pricing story. They keep pricing low. This is like a scaled economy, shared kind of business. As they get scale benefits, as they grow, they pass it through at lower prices. So you're talking almost double-digit same-store sales growth, all from volume. And this is a concept where you're like, look at this 5-year period. This company continues to do incredible in a variety of environments.
Yeah, there's other names in here as well. TSMC.
Oh yeah.
Familiar with that one, Nintendo. But again, that's on the tech consumer-driven space. Is it a regional story? Is it fundamental story? Like to your point before, these have performed throughout that 5-year period?
Yeah, absolutely. I think, look, the Parnassus philosophy, moat, competitive advantages, relevancy, we're talking about products and services that are going to be relevant and increasingly relevant for a really long period of time, management quality, sustainability, and stewardship. Those are our 4 pillars. You look at a company like Taiwan Semiconductor, people love to talk about NVIDIA, but everyone forgets, like Taiwan Semiconductor makes all of NVIDIA's chips. Right. And you talk about like, what would happen to the world if this company disappeared? It's a good litmus test on how important this company is. Like the fundamental progression of technology would cease if Taiwan Semiconductor ceased to exist. And like that's a company you want to own for decades.
It's interesting how it's following the same path in terms of sectors that we find attractive here in the U.S.
It's the same exact theme across the board. You're looking for those who can weather storms or have a product that is not 1 year, not 3 year, not 5 years, kind of like what Chris said yesterday. Talking about NVIDIA priced for perfection for 10 years. You're looking for other companies that are going to be part of that same story. Taiwan is 100% one of them. Yeah. And there's so many of them other ones out there as well. People who just don't talk about them all the time. But the sectors are the ones that are getting hurt. The other sectors, everyone forgets there's 11 GIC sectors in the S&P, right? Not one.
Yeah, which is kind of crazy because you would think, energy, utilities, and some of the others with
finance, real estate.
And you need all those to satisfy the energy demand that is a result of all these emerging technologies.
The only reason we're talking about utilities lately is because of the infrastructure spend that you need for AI, right? So think about that. You had a huge nuclear deal a couple of weeks ago announced. That was a headline for 3 days and went away. They haven't even broken ground on that yet, right? And you bring up Siemens.
Yeah.
I mean that's a bellwether in Europe, isn't it?
Well, Siemens AG is the big one.
Yeah.
Siemens Energy is their energy-specific business, but yeah,
Yeah.
bellwether throughout Europe.
Right. So there's the utility space. They're paying dividends. That sector has done extremely well over the last 18 months. People know utility was just a dividend play for decades, right? So there's lots of other ones out there. It's just got to wait till the market comes around to realize that these are undervalued and they need to be owned.
We'll let Ken's team do the fishing.
Yep.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.